Hello agents, hello everyone. So today we're going to talk about the split annuity again. Rates are up, so we're going to look at this one. But first I want to discuss what a split annuity exactly is. It's two insurance products to complete one goal. It's mostly used for non-qualified money because non-qualified after-tax money will have an exclusion ratio on that payment. So it's a little less tax on every payment coming out, whereas if you just strip interest, it's 100% taxable. And the reason you use non-qualified money is because you get that qualified money, such as IRAs and pensions and stuff. You don't get, it's 100% taxable in most cases, unless it's a Roth. But you don't use it for that because you can probably get a better end of year annual payment used just stripping the interest from the highest multi-year guarantee annuity, the highest fixed rate you can find. Unless, but if you do the interest, you're going to have different payments depending if there's 28 days or 30 days in the month. So your payment will change. So only reason you'd really use this for qualified money is for some reason you want to have the exact same payment every month for the set period of time, right? Otherwise, qualified money we use to strip the interest scenario. So let's jump into this again. Two products for one goal. Even if it's with one insurance company, you're still buying a MYGA, multi-year guarantee annuity, and a SPIA, single premium immediate annuity. SPIA for the income, MYGA for the growth. So let's jump into the current rates on this. And I'm going to do another one of these next month. So this one's just because these rates, I had a mid-month rate increase from this particular group of carriers, and they're like on top now. But I'm hoping in September with that 10-year at 422 today, as you saw on the first screen, we get more rate increases. And I've heard through the grapevine already, there are some substantial increases coming with some companies. Haven't seen them, so I don't know what that's going to be. So anyway, let's look at this. These quotes I ran on the 22nd, but these rates are still valid today, the 24th. Of course, rates are subject to change at any time after, they're discussed because, that's the rules. So $500,000 going in, and this is going to assume a non-premium tax states. These states here may charge a premium tax, which would lower the income payment. The deferred side would stay the same, but the income side would be reduced because of the premium tax. So, okay, that's good enough for that. So in this scenario, we're going to put $382, $567, and 18 cents into the MYGA. That's a 5-year. Now I can do these, we can do shorter, but they get a little lower yield, but all the way to 10 years. So call it 5 to 10 is the sweet spot, but we have done 3 to 10 limited states on those. But yeah, we're going to talk about the 5-year today because it's a easy one to do. So $550 for all 5 years with this company. We're going to put the difference $117,432 into the SPIA, the single premium immediate annuity, and that's going to kick off an income of $2160 per month for that 60 months for 5 years. So assuming this is 100% cost basis, because even though it's after-tax money, it might not be 100%, maybe there's some gain in it. But assuming you just took the money out of a checking account or something, putting in, 90% of that payment would be excluded from tax for that 5 years. Next would be the growth. So that 550, that 382, 567 grows back to $500,000 for after 5 years. Now, I like walkaway MYGAs, which mean after the term, they're liquid and you can move them, stay, go. There's no time frame. There's no more recurring charges. However, this product does have a 30-day only exit window after 5 years. So you got to make a decision to get the money out or move it somewhere else in a 30-day window. So that's the only caveat with this one. I don't really love those windows because it does pressure people, but this one does have a 30-day window at the end. So you got to leave, or they'll declare a new rate for the next 5 years, but then you're in it for another 5 years. That's how that one works for that MYGA right here. After 5 years, of course, the SPIA, this 117 is gone. You used it as income, right? So now you just have this 500,000 in the MYGA, and that's 382. So you have $117,000 of gain. So if you did cash this out, that gain would be the taxable portion of the whole thing. Or you could do a 1035 to another annuity, or you can do a partial 1035 and do a split annuity again. There's a bunch of different things you can do at the end of that 5 years, but just be aware that there is a window on this particular product. Not all of them have them, but a lot of them do. And the reason they brought these windows in was to raise yields when rates were so low. So the insurance companies, the thinking on this was that, hey, a bunch of people aren't going to renew and we can put the rate low and they'll be locked in, So that's kind of a way for them to keep the money on the books, if you will, for people who aren't paying attention or just decide to stay, or if, there's not another good alternative out there, they got a potential to keep that money on the books at the insurance company. So that's the reason for these. And of course, all the stuff I quote, is net of fees and charges. There's no additional fees or charges. This one has a built-in commission. So it's 3% on both sides, agents. You can see the reduction there on 81 to 85 at 225. So and if your clients watch these things, that's fully disclosed. That's what it is over the 5 years. That's the thing. And this is a pretty high commission, but the rates are the best. So really, we don't worry about comp. We worry about who's giving the best payout and who's giving the best fixed rate. And today, if you look back at some of my previous videos, you'll see lower comps and lower rates. So it's all about doing the best rate. Now, one of the reasons this rate is low, higher, and the comp is bigger, is this company's a little bit lower rated. They're B++ by the AM Best company. They're a B- Weiss, which is pretty strong for Weiss rating. And they're a 40 Comdex overall. The total rating of all insurance companies puts them at, 40 out of 100. So they do have a Comdex. Not all companies even have a Comdex. The highest Comdex, of course, is 100. So anyway, that's just disclosing what the company's ratings are and their financial, of course, all financial strength is based on the claims paying ability of the company. However, it is a $27 billion company, and you never know, those rates, they could always get a rating increase, but as of right now, those are their rates. So let me show my work. So this is just a screenshot of part of the illustration. Of course, the illustration's multiple pages, but this is a screenshot of it to make it simple, of the pertinent information here. So this is the 5-year SPIA. As you see, 117 going in and 2160.40 a month with the exclusion ratio there, assuming the whole 117 is what they call cost basis, right, agents? So 2160, that shouldn't say 860. That should just say times 60 months. So that's a mistake I made, but it equals 126.24 guaranteed. That's your total income for 60 months, not 860 months. So oops. I think because I took a template of a 7-year, which was 84 months, and I must have left that in there. So oops, sorry. Income will be lower, of course, in premium tax states. So here's the MYGA. The MYGA is 5-year at 5.5%. And as you see, it grows to $500,000, right? And again, not approved in New York. There's issue ages to 85. The product has a 30-day exit window. Surrender charges will renew if no action is taken in that 30 days. Not illustrated, but available is if you need to access some money on this, it allows interest withdrawals. Of course, if you access the deferred side, it won't grow back to 500,000 because you're taking the money out and it's not earning interest on them. So whatever you take it out and whatever the interest you would have earned on that is not going to be there, right? But it is available, just so you know. It's not completely locked up if you needed to access the other side as well. And of course, it would be interest out first, so the tax issues on that. And here's what the 30-day window looks like. They did a cool thing on their illustration. They actually break it down. Not a lot of companies do this. I like this. So you can see at the end of the 5th year, you have that 30-day window where the accumulation and surrender values match, whereas in the big illustration, they don't match because they're assuming the 30-day window didn't happen. You didn't take it, so you'd renew surrender charges on that. But if you do it in the 30 days, the cash surrender and the accumulation value match off. So that's how that's it. I wanted to show my work on that. And if you're looking for a quote, you know how to do it. Go to annuityexperts.com, split annuities, fill it out as much as you can. If you do it right, you'll get that. And here's some disclosures regarding annuities and all that good stuff. So that's the end of my presentation. Split annuity, August 22, 2023 rates, subject to change at any time. And hopefully we get some rate increases. And as soon as I know the rates for August, either way, up or down, up or even probably, I'm going to do the A-rated split annuity with the A+ SPIA and probably an A-rated MYGA, so you can see it out there. And just in case anyone's worried about their ratings or looking for a higher rated carrier. Okay, so that's it. Any questions? 800-373-9697. Follow me on LinkedIn and YouTube for the most up-to-date information. And hope you're all having a good week. And let's see what happens for September. Take care. Bye-bye. Bye-bye.